because of the great uncertainty about LIBOR's futures and the risk to financial stability that would likely accompany a disorderly transition to alternative reference rates, I think we need aggressive action to move to a more durable and resilient benchmark regime. As always, what I say reflects my own views and not necessarily those of the FOMC or the Federal Reserve System. So although the backdrop to the current reference rate reform efforts is well known, I think some historical context is useful when considering the issues that are facing us today. That history, I think, highlights why alternatives to LIBOR are needed. It also illustrates the importance of continuing to focus on bank culture and making sure we have the proper incentives in place in order to support financial stability over the longer term. Now, at its core, the problem we face today is that the financial system has built a tremendously large edifice on a structurally impaired foundation. While many in the industry cannot recall a time when LIBOR did not exist, in fact, it was only developed in the 1980s. And since then, the use of LIBOR has exploded as a reference rate, with the size of financial contracts referencing US dollar LIBOR today estimated at close to $200 trillion. The vast majority of these obligations are derivatives, mainly interest rate swaps. But the tally also includes trillions of dollars of cash products, such as residential and commercial mortgages, corporate bonds and loans, and other securitized products. And with new contracts referencing LIBOR still being written, this balance is still growing. So broadly speaking, reference rates are vital to have efficient market functioning. They facilitate trading in standardized contracts. That lowers transaction costs, and that increases market liquidity. Robust reference rates also can reduce information asymmetries and the risk of misconduct by providing a source of clear, transparent, and independent pricing. But unfortunately, in the case of LIBOR, the foundation had some serious flaws. Most notably, LIBOR was, and I would say is, based on submissions from individual banks, which in turn were based on hypothetical borrowing rates or expert judgments, not actual transactions. Moreover, deficiencies existed in terms of regulatory oversight and the governance of the rate-setting mechanism. These vulnerabilities, as we remember, enabled the manipulation of the rate for the financial benefit of individuals and institutions. And amid profound breakdowns in controls and compliance, individual traders conspired with their rate submitters at their institutions or with traders at other firms to manipulate the setting of the rate to improve their trading results. During the global financial crisis, panel banks also reportedly submitted lower borrowing rates than they could actually obtain in the marketplace. They did so to disguise their financial fragility at a time when uncertainty over bank liquidity and solvency was high. Now, the resulting LIBOR scandal, I think, was particularly disturbing because of its scale and the flagrancy, including the fact that there was collusion by employees across firms. It did lead to billions of dollars of fines, jail terms for some individuals, and most importantly, severe reputational damage to the financial industry as a whole. The global financial crisis exposed excessive risk-taking and a long series of lapses in judgment. And I think the LIBOR scandal further undermined trust in the ethical standards of the banking industry. To my mind, that scandal provides many cautionary lessons, including the way in which poor technical design can be exploited, the limits of self-regulation, the problems that arise when one's loyalty is to one's trading co-conspirators rather than to one's institution, and the need for robust controls. It also underscores the power of incentives to drive individuals and firms to do things that are imprudent and/or unethical. And the governance and control framework that the banks and the LIBOR administrator had in place proved woefully insufficient to prevent this misconduct which stemmed from these poor incentives. So in this context, one could say that the whole LIBOR situation and the scandals that result was a situation that was just ripe for exploitation. The openness and brazenness of the misconduct as captured in recorded transcripts also point to, I think, serious deficiencies in bank culture. My New York Fed colleagues and I have commented frequently on the need for sound culture and incentives. as a complement to effective regulation and supervision. Now, there has been some progress on this issue in recent years, but the fact that we're seeing additional breakdowns at individual banks point to the fact that the work on strengthening bank culture isn't done. And I look forward to the discussion with Manoush and Andrew on the panel that we're going to have just in a few minutes to talk about how we can improve culture in the fixed income, currency, and commodity markets. Now, one of the key lessons from the financial crisis was that critical pieces of financial system infrastructure must be both strong and resilient, and the LIBOR scandal certainly underscored that need. The essential problem with LIBOR is the inherent fragility of having an inverted pyramid, where the pricing of hundreds of trillions of dollars of financial instruments rests on the expert judgment of a relatively few individuals, informed by a very small base of actual unsecured bank transactions. Moreover, that base has contracted further in recent years due to many factors, including regulatory reform and the fact that central banks have been embarked in quantitative easing in many of the major advanced economies. Relative to the vast sums of US dollar LIBOR contracts that I mentioned earlier, $200 trillion roughly, the median daily volume of unsecured 3-month US dollar wholesale borrowing is very small. It's running at about $1 billion per day. And many days see less than $500 million in volume. This lack of market liquidity means that these rates cannot be sufficiently transaction-based to be truly representative. And as we know, rates that are not transaction-based are at more risk of being manipulated. So despite efforts to improve LIBOR in recent years, and there undoubtedly have been changes that have strengthened its administration and governance, so I think we have to concede that point, the lack of underlying market liquidity for nearly all currencies and maturities remains a problem, and there is no obvious solution. The setting of LIBOR still depends heavily on expert judgment. Even for US dollar LIBOR, actual transactions are the basis for only about 1/3 of the rate submissions for tenors of 1 month and 3 months. And that's particularly noteworthy because those are the maturities that are referenced by the bulk of financial contracts. In light of the history of LIBOR, in the context of more than $320 billion in overall misconduct fines since the crisis, banks are naturally reluctant to assume the legal risks associated with submitting quotes based on what are very shallow markets. Indeed, that's why some banks have actually left the individual LIBOR panels in recent years. Andrew Bailey drove this home this point in his July 2017 speech. He explained that the Financial Conduct Authority had to really press hard to persuade banks to stay in the panels and voluntarily submit LIBOR quotes through the end of 2021. LIBOR's potential cessation after 2021 poses a clear risk to financial stability, and prudent risk management means that all of us need to prepare now for a world without LIBOR. In recent years, international and domestic authorities alike have worked with the private sector to address LIBOR shortcomings and to try to find alternative reference rates. One notable development has been the publication of an international set of principles for financial financial benchmarks, which was developed by the International Organization of Securities Commissions, or IOSCO, in 2013. These principles, which include 19 specific standards across governance, benchmark quality, methodology, and accountability, have emerged as the international standard. IOSCO is rightly focused on tying benchmarks more closely to observable arm's-length transactions. This represents an important step towards eliminating excessive reliance on expert judgment. The Financial Stability Board, which Mark chairs, has been a galvanizing force at the international level. The FSB and its members have published proposals, plans, and timelines for reference rate reform, and they promoted the strengthening of the major interest rate benchmarks. The FSB has been carrying out work on the development and introduction of alternative benchmarks. It has been developing a plan to accomplish a transition to new benchmarks. It has been encouraging work by the private sector on contract robustness, and has been reporting regularly on the progress that's being made. The Federal Reserve, on our part, has played a lead role in the development of these recommendations as how they would be applied to US dollar LIBOR. working closely with the other major financial regulatory authorities in the United States. And this effort has also involved coordinating with the official sector sponsors of similar efforts that are taking place around the world. In late 2014, in response to the initiatives of the FSB and the Financial Stability Oversight Council recommendations, the Federal Reserve convened the Alternative Reference Rates Committee, often referred to as the ARC. This is a group of market participants established to identify more robust alternative US dollar reference rates that are risk-free or nearly risk-free, fit the needs of a derivatives market, and are compliant with IOSCO principles. This effort paralleled similar ones in other jurisdictions to find reference rates that are well suited to local conditions and market needs, and that includes the UK's working group on sterling risk-free reference rates. The ARC was tasked with developing a transition plan to facilitate the adoption of these rates in a voluntary and orderly manner, and with considering best practices in terms of contract design to prepare for the possibility that LIBOR ceases to be published. The ARC has made important progress in achieving its mandate. Notably, in June 2017, it selected the Secured Overnight Financing Rate, or SOFR, as the preferred alternative to US dollar LIBOR. SOFR is a broad measure of the cost of borrowing cash overnight using US Treasury securities as collateral, and is thus relevant to a wide range of market participants. The rate is entirely transaction-based, and the underlying market is robust, with current daily volume of more than $700 billion. So by comparison, unsecured 3-month US dollar wholesale borrowing totals roughly $1 billion per day, as mentioned earlier. SOFR moves closely with LIBOR and other money market rates over time. And because it covers multiple segments of the repo market, I think it does provide scope for future market evolution. Besides being more resistant to manipulation, this nearly risk-free rate should also prove to be more resilient during periods of financial stress, because the US Treasury repo market is likely to remain deep and active during such episodes. The New York Fed administers and produces SOFR in cooperation with the Office of Financial Research. We began publishing this rate last month on April 3rd, along with 2 other repo rates, the Tri-Party General Collateral Rate and the Broad General Collateral Rate. This work complements steps by the Federal Reserve to promote greater transparency in rates in unsecured markets. We've already done this through enhancements in terms of how we calculate the effective federal funds rate, and in launching an entirely new rate, the overnight bank funding rate. I've long been a proponent of the idea that central banks are well suited to take on this responsibility. Reference rates have strong public good properties, and the private sector, as we've seen, faces notable coordination challenges in this area. Central banks have had a long history in producing such measures, recognizing that traditionally these have been mostly related to monetary policy, and central banks are trusted independent parties. Also, in my view, central banks ultimately own the financial stability risks that are present when key reference rates are flawed. So, in my mind, better to recognize this responsibility, act proactively to mitigate such risk, than to step aside and hope that someone else will take up the mantle of reform. The Federal Reserve has designed these benchmarks to be compliant with the IOSCO principles, with regular review by oversight bodies and a comprehensive ethics and conflicts of interest policies established for staff. Best practice also dictates that administrators periodically review the rates they produce to assess whether changes in the underlying markets require changes in how these rates are administered. We at the New York Fed have dedicated significant resources to these efforts, and we're committed to the continued production of rates so that market participants can have confidence about their long-term viability. So for these reasons, the Federal Reserve very much concurs with the ARC that SOFR represents a compelling alternative to US dollar-based LIBOR, particularly for most derivatives transactions where a near risk-free rate is more appropriate than a rate that incorporates a bank credit risk premium. Nevertheless, we have to accept the fact that market adoption of SOFR faces its own set of challenges, such as the development of sufficient liquidity in derivatives that reference SOFR, and the establishment of a term reference rate. This is a subject I'm going to discuss in a moment. These elements will have to be built over time. The ARC's PACE transition plan lays out a timeline for the milestones that must be reached over the coming quarters and years for us to have a successful transmission. I'm confident that the ARC will succeed, but I think it's going to take considerable attention and effort. Progress is already evident. The Chicago Mercantile Exchange began offering SOFR futures contracts earlier this month, and trading activity is off to a good start. Development of SOFR derivatives, in turn, will support creation of a term reference rate. Although the ARC's transition plan anticipates that this will be completed by the end of 2021, I think it would be much better if this were to occur more expeditiously. Now, the good news is that this is broadly appreciated. In this vein, the committee's second report discussed some of the term rate alternatives, and development of proposals for a term reference rate was recently added to the ARC's mandate. In this regard, I'd also encourage market participants, academics, and other interested parties to contribute to the effort to develop a term reference rate. Another key area of focus, which was further motivated by Andrew's warning, is the development of fallback contract language in the event that LIBOR ceases to be published. The absence of such language creates a potential for large-scale disorder in global financial markets should LIBOR suddenly go away. This is an unacceptable risk. The International Swap Dealers Association, ISDA, has been working on this issue for the derivatives market, and they're expected to issue a consultative document soon, and I think that'll be important for making further progress in this space. The ARC has also been coordinating a similar effort across cash products of all types. The goal is to achieve a consensus on a consistent approach across markets whenever that's feasible. Now, as I've noted previously, LIBOR continues to have significant shortcomings despite the fact that governance has been strengthened in recent years. And uncertainty about its future is only going to grow over time as that 2021 deadline approaches. This uncertainty reflects the limited liquidity underlying LIBOR and the corresponding legal risks that I discussed earlier. But I'm also skeptical about whether LIBOR can ever be adequately transaction-based. As Andrew highlighted, there's no guarantee that LIBOR will continue to exist beyond December 2021. So in my view, we have to operate on the proposition that LIBOR is likely to go away. And I would even go a bit further than that and say it should go away because it's not supported by a sufficiently robust regime. The LIBOR countdown clock should provide an impetus for action, but it should also make market participants and regulators nervous as we approach the deadline, especially if longer-term solutions are not in place. Time is of the essence, and I think we have to manage that time well. 2021 seems a long time off, but there's a lot of work to do to actually get to that point successfully.